Welcome to another video where I would like to focus on the important question of whether it is still worth investing in stocks, specifically in the S&P 500 index. What is the current situation, a summary of the most important events of recent months, and how I would invest if I were starting now. There is often talk that stocks tend to fall in September, at least that has been the case in recent years. So is that a reason to sell now and reinvest in October instead? As a bonus and conclusion, I will analyze my overall view of large technology companies, such as Microsoft, Google, and so on. Do they still make sense in terms of valuation, or could they already be in a stock bubble? We have a lot of interesting topics and questions ahead of us, so sit back, relax, and let's get started. First, I want to start with the S&P 500 index, how it has been performing recently and over the years, and how it compares in terms of valuation to the earnings of the stocks within it, whether it is already too overvalued. And if we look at the recent 20% drop due to Trump's tariffs, that is long gone, and the index has only grown since then. Since the beginning of the year, it has yielded up to 10%, and we are at new highs. If we look at the performance of the S&P 500 index, this is the third very successful year in a row. While in 2023 and 2024 it brought investors a return of around 25%, we are now at 10%. And the average return over the last 10 years is 13.3%, which is more than good compared to the historical average of around 10% per year. But the fact that stocks are hitting new highs and are at their peak is actually happening most of the time. However, it is necessary to look at this from a valuation perspective. Are we already in a stock bubble? And if we look at the current P/E ratio, which means how many times the annual profits of companies within the S&P 500 index we can buy the companies for, then the P/E ratio is currently at 30. Historically, the average could have been somewhere around 15. Perhaps more likely for the last 20 to 30 years, the average will be higher, around 20 somewhere. But that is still up to 50% more than the historical average. Sure, strong corporate earnings growth is expected in the future, somewhere above 10% per year, but at first glance, this seems like a fairly high valuation to me. However, it is often mentioned that stock markets always fall in September, and historically, looking back to 1945, the month has always ended in losses on average. But that certainly does not mean that this has to be the case every September. Last year, there was no major decline, but in 2023 and 2022, there was a larger decline of up to 10% in September. Some correction may well occur, but that is certainly no reason to sell everything and reinvest in October, definitely not. But before I get to comparing the companies that drive most of the index's growth, which are the big tech companies, I'd like to give some context on where interest rates and inflation are in the world, and above all, how the economy is doing in terms of GDP growth. Just a few years ago, inflation was a major problem, reaching around 10% in the US, forcing central banks to raise interest rates. However, for the last 2 years, they have been lowering them. The European Central Bank has even lowered them to just 2%. But the Fed in the US has not lowered interest rates as much, leaving them at 4.5%, which is definitely higher than the rest of the world. The reason was the ever-growing GDP, and inflation occasionally jumped to 3%. Due to Trump and his tariffs, the impact on inflation will remain unclear for now. That is why the Fed is cautious for now, even though Trump constantly criticizes Fed Chairman Jerome Powell for his incompetence and demands that he lower rates to 2% so that the US can repay its debt more cheaply. While this is logical, such a reduction could further boost the economy and increase inflation again. In any case, it is expected that interest rates will indeed be cut at the Fed's September meeting, and probably once more before the end of the year, bringing rates down to 4%. But how should we proceed? Should I invest in the S&P 500 index today, or in other stock indices, such as the MSCI World Index? At first glance, it may seem overpriced, and has grown strongly over the last 3 years. But if we invest regularly each month using the DCA method, then I believe it is ideal to continue doing so. If we want to invest a larger amount at once, e.g. hundreds of thousands, then I think it is better to spread the investment over, say, 10 months, to avoid investing at the peak and then waiting a long time to get back to the peak. However, I would still like to take a look at the largest stocks that are driving the S&P 500 index to new highs. These are the big tech companies, also known as the Magnificent Seven, which also includes Tesla. But I wouldn't really include it there, as it doesn't make sense to me. In any case, the share of these companies in the S&P 500 index has been growing in the long term, and today the largest companies actually make up 35% of the entire index, which is quite concentrated. But which big tech companies make sense to invest in today? At first glance, Nvidia is the most expensive in terms of valuation, with a PE ratio of almost 60, while Google remains the cheapest in the long term, with a PE ratio of 22. On the other hand, NVDA is still expected to see the highest growth in the future, at 20 to 30% per year in profits, assuming of course that it maintains its huge profit margins of up to 50%. This was confirmed by Wednesday's result. Where I find the P/E ratio to be quite exaggerated is with Apple, where growth of barely 5% per year is expected, but the P/E ratio is higher at 35. For me personally, Google is still attractive today and also holds the largest position in my portfolio. It is a great company, and so far, it does not look like it has missed the AI revolution. Quite the contrary. The same goes for Microsoft, which is implementing AI more than well into its services, and is also expected to see higher profit growth in the future. It could be up to 15% per year, which, with a PE ratio of 35, does not seem like an exaggerated valuation to me. So, although almost all big tech companies have grown to new highs in recent months and continue to grow, in terms of valuation, they are not that overvalued, certainly not all companies. I would definitely not call it a stock market bubble, but it is possible that the expected growth in sales and profits is too optimistic due to the overall hype. Only time will tell. Okay, but what can we take away from all this? The S&P 500 index and many other stocks are at their highs despite the ongoing war in Ukraine and Trump's tariffs. It is very likely that the S&P 500 index, with a P/E ratio of 30, is overvalued compared to some historical average. The largest stocks are also at their highs, and valuations are not the cheapest, but I still think there are stocks or sectors to look at and invest in. If you invest regularly in indexes every month, then, of course, there is nothing to worry about, and you can continue. But if you are looking for a sector in trouble or undervalued stocks, then, for me, it is, for example, the healthcare sector. But of course, this video does not contain any investment recommendations, and everyone should form their own opinion. What about you? How do you view the current valuation of the index or large technology stocks? Please share your insights and answers in the comments below.